All right, we're doing a real technical deep dive today into a fascinating corner of military tax law. We're talking about Public Law 110-245, better known as the HART Act, and we're going to focus on one of its most powerful and honestly most misunderstood parts, the non-taxable combat pay election for the Earned Income Tax Credit.
So here's our game plan. First, we're going to look at the problem, this bizarre thing called the combat penalty. Then we'll walk through the law that fixed it, Public Law 110-245. We'll get into the nitty-gritty of how the election actually works, and then talk strategy, when to use it and when to avoid it. After that, we absolutely have to clear up the confusion around lookbacks, and finally, we'll talk about why this law's legacy is so important.
Okay, let's kick things off with a situation that was, well, just fundamentally unfair. It was a flaw in the tax code that had the unbelievable effect of penalizing military families just for being deployed.
I mean, think about that question. It sounds crazy, right? But before 2004, the answer was, way too often, a definitive yes. This whole mess came from the accidental collision of two different parts of the Internal Revenue Code that just did not play well together.
Okay, so piece number one of this puzzle is IRC Section 112. Now this law's heart is in the right place. Its job is to make combat pay tax-free, which is a great benefit. But here's the kicker. By excluding that pay from your gross income, the law effectively made the money invisible on your tax return. Poof! It's like it never even existed.
And this is where it all went wrong. You see, the Earned Income Tax Credit, or EITC, which is governed by Section 32, is based on your earned income. But the old rules defined earned income as only the money that was includable in gross income. So you see the problem? If a junior soldier's only income for the year was that tax-free combat pay, their official earned income for the EITC was zero, a big fat goose egg. And a zero earned income means a zero credit, potentially costing that family thousands of dollars. They were literally being financially penalized for serving in a combat zone. Just wild.
Obviously, this combat penalty was a serious problem. It was an issue of fairness that Congress had to address, and after a few years of putting temporary band-aids on it, they finally came through with a permanent fix. You can see how it all unfolded right here. Starting in 2005, we had these temporary patches and extensions, but that year-to-year uncertainty is just brutal for military families trying to plan their finances. Finally, in 2008, Public Law 110-245, the HART Act, came along and made the fix a permanent part of the tax code, which was a huge relief.
So how exactly did the HART Act solve this problem? Well, let's dive into the technical nuts and bolts of what it created, the Non-Taxable Combat Pay Election, or the NCPE.
The fix itself is actually a really elegant piece of lawmaking. What it does is amend IRC Section 32. But, and this is the genius of it, it doesn't make combat pay taxable. Not at all. Instead, it gives service members a choice, an election in tax speak. You can choose to make that combat pay visible again, but only for the single purpose of calculating your earned income tax credit.
Now, there are three absolutely critical rules you have to understand here. First, it's elective. It's not automatic. You have to actively choose to do it on your return. Second, it's laser-focused. It only applies to combat pay under Section 112, not other allowances like BAH or BAS. And third, and this is the really crucial part, it reclassifies the pay as earned income for the EITC, but it does not touch your adjusted gross income or AGI. Your AGI stays exactly the same.
And there's one big ground rule here. It is all or nothing. You can't get clever and say, I'll just include $15,000 of my combat pay to hit the sweet spot. Nope. The law says you either elect to include 100% of your combat pay for that year, or you include none of it. It's a simple, binary choice.
The law also has this really fantastic feature that gives a ton of flexibility to dual military couples. On a joint tax return, the election is personal to each spouse. So, spouse A could choose to include their combat pay, while spouse B chooses to exclude theirs. This allows for some incredibly precise fine-tuning to get the best possible outcome on your return.
So this brings us right to the heart of the matter, the big strategic question: to elect or not to elect? And listen, the answer is not always obvious. It really requires you to run the numbers both ways and see which choice actually benefits your specific financial picture.
This table really lays it all out. Just look, making the election doesn't change your gross income or your AGI one bit. The only number that moves is your earned income for the EITC calculation. And that's the trade-off, right? Increasing that number helps you on the way up in the phase-in range, but it can also push you into the phase-out range much, much faster.
Let's make this real with a couple of examples. For a junior service member with pretty low taxable income, making this election is a home run. It turns their combat pay into a tool to maximize their credit. It's a clear win. But for a more senior NCO with higher taxable pay, adding all that combat pay on top could push their total earned income so high that it craters their credit. For them, the best strategy is absolutely to not make the election.
And the reason that happens comes down to a technical detail in the law called the greater of rule. Basically, the EITC phase-out kicks in based on whichever of two numbers is higher, your AGI or your earned income. So when you make the election, you are intentionally inflating your earned income. If that number gets bigger than your AGI, boom, that's now the number that triggers the phase-out. It's a really smart design that keeps the benefit targeted to those with the lowest overall income.
Okay, we need to hit pause here and clear up a really common point of confusion. People associate the HART Act with the term lookback all the time, and it is vital that we distinguish between a few different things.
So let's just get right to it. Is the non-taxable combat pay election we've been talking about a lookback? The answer is simple. No, absolutely not. The NCPE uses your current year's combat pay. A true lookback lets you use a prior year's income. They are fundamentally different concepts from totally different laws.
This matrix makes the distinction crystal clear. Now, the HART Act did have a one-time lookback, but that was specifically for the 2008 stimulus checks. It's ancient history. The permanent provision it created, the NCPE, uses current year income. The thing most people think of as a lookback, the one that lets you use last year's income for this year's EITC, that comes from completely separate disaster relief laws. They are not the same thing.
So what's the bottom line here? What is the lasting legacy of this really smart, really targeted piece of tax law? Well, it's pretty much a textbook example of how you solve a complicated problem with a simple, elegant solution.
You know, tax policy experts really admire the HART Act because instead of taking a sledgehammer to the tax code and changing the fundamental definition of gross income, Congress used a scalpel. It created this precise little tool that says, for this one specific purpose, we're going to treat this non-taxable pay as if it were earned income. It solved a huge fairness issue for military families without causing a bunch of unintended problems somewhere else. It's just clean legislation.
And that leaves us with a final, fascinating question to think about. This core idea from the HART Act, allowing specific, non-taxable income to count for targeted credits, is a powerful blueprint. So you have to wonder, where else in our incredibly complex tax system could the same elegant solution be applied to fix other hidden inequities?